Okay, we're getting started. Just going to give it a few moments, let the room fill up. All right. Grateful for everybody that's showing up today. Thank you for being on time. I see more people are entering the room, so I'm just going to give it a few more moments. Really appreciate you guys coming. Really appreciate you coming. All right, making progress over here. Good stuff. Okay, let us begin. Good morning, everybody. Welcome. Thank you very much for joining me on this exciting webinar where we're going to be talking about some very important information for those of us who are planning on collecting Social Security early. We're going to talk about the earnings test, and we're going to talk about ways to outsmart the earnings test. This is a good topic, and I want to first give a shout out to my clients and my members. For those who don't know, these webinars, they don't happen in a vacuum. They happen because I have people who are supporting me and encouraging me. If you know somebody who's one of my clients, one of my members, do me a favor, go give them a hug from me. And maybe you yourself would consider becoming one of my clients, one of my members. And if you're interested in that, I could show you how to do so at the end of today's presentation. Okay, without further ado, let's dive into the Social Security earnings test. Now, some of you may not know that I have a general opinion about when to collect Social Security. I have exceptions to my rules, but I have my general rule. My general rule, for those who don't know, is a person should collect Social Security as early as possible. As early as possible. Now, I'm not going to go into that reasoning today. That is another webinar, which if anybody is one of my clients and members, you have access to that archive of webinars. So you have the ability to listen to my thinking and my philosophy as to why I encourage people to take Social Security as early as possible. The earliest you could take Social Security is age 62. That is the earliest you can take 62. You can take Social Security at 62. If you don't want to take it early, if you want to wait till full retirement age, your full retirement age is going to depend on when you were born. So if you guys see this slide over here, FRA stands for full retirement age. Full retirement age for most people these days is age 67. If you were born 1960 or later, your full retirement age is 67. Some of us were born before 1960. If you were born in between 1954 and 1959, you're going to have a different FRA 66, maybe 6 in a few months. But for most people in this room, their full Social Security is going to be at FRA. However, as I said, you do not have to wait until after FRA. You do not have to wait until you are 67 years old to collect Social Security. You could collect Social Security as early as age 62. And as I said, I encourage people to take Social Security as early as possible. However, I have exceptions. Even though my general rule is to take Social Security as early as possible, I have 3 exceptions to the rule. One of those exceptions we're going to talk about today. One of those exceptions is if you are still working and earning money and subject to the earnings test. If you are still working and earning money and you are subject to the earnings test, then that is one of the cases where I'd say, you know what? Okay, I guess let's not collect Social Security, but instead let's delay Social Security. And let's talk about what that earnings test is. If you're making too much money, they will reduce your Social Security benefit. How much money is too much money? So on this next slide, you will see Social Security actually has different earnings tests depending upon how early you are collecting Social Security. So you could collect Social Security before the year you turn FRA. So if you guys see on this slide on the left-hand column, how early? So you could collect Social Security before the year you turn FRA, or you collect Social Security in the year you turn FRA, or you collect Social Security FRA and beyond. Okay, so let's give an example. Let's say somebody's going to be turning FRA. They're going to be turning full retirement age, which for many of us is 67. Let's say they turn full retirement age in August of 2025. Let's just pretend that's the case. August of 2025. So what that means is once they reach the month of August 2025, they have already hit the month where they turn FRA. Starting from that month and onward, there is no more earnings test. Again, in my example, I'm just giving an example of somebody's going to turn FRA August of 2025. If you turn FRA in August 2025, once we reach August, the beginning of the month, even if your birthday is not till the end of the month, but once we reach the month of August 2025, there is no more earnings test. You could be making $1 million. We do not care. We do not care. In fact, let me ask it as a question. I don't know if anybody here in this room, is there anybody in this room who is already full retirement age right now? Well, I have news for you. If you are full retirement age right now, you know what that means? You could be collecting Social Security right now, even if you're still at work. You could be collecting Social Security right now. And by the way, when I meet people who are still working and they're already FRA, and I tell them they could collect Social Security right now while they're still working, they say to me, no, Stefan, I don't need the money right now from Social Security. I'm still working, so I'm fine. I'm good to go. I look at them and I say, you don't need the money? Well, then definitely take the money. Definitely take the money. And you know what you could do with that money? You could take that money and you could put it to work for you. You could invest it. You could apply it towards some sort of growth instrument. So even if you don't need the money, you could still take that money from Social Security. Now, I sometimes have a little bit of a reservation if taking the Social Security benefit is going to land the entire benefit in the next tax bracket up, usually the 32% tax bracket, but I'm not getting tangled in that right now. So let's just leave that aside. So somebody who is already full retirement age, you could collect Social Security right now. Even if you're making $1 million, we do not care. However, back to my example, if somebody's turning FRA in August of 2025, then from January 2025 until July of 2025, that is in the calendar year you turn FRA. So that is the middle row. In the calendar year you turn FRA. And you'll notice in that calendar year you turn FRA, the earnings test threshold is $51,960. And that's the 2022 numbers. Every year those numbers get adjusted. $51,960. That's on an annual basis. If you break it into a monthly, it's $4,330. If you are making beyond that amount, if you are making beyond $51,960, for every $3 in excess, you lose $1 of benefits. Okay, so let's give an example. Somebody who's making $100,000. So if they're making $100,000, they are about $48,000. Let's just ballpark it, $48,000 over the limit. So every $3 in excess, you lose $1 of benefits. So basically, you're going to lose about a third of $48,000. So whatever a third of $48,000 is, that is what you are going to lose. Do some quick math over here. Quick math is not my strong point. Just do it very quickly. 48 divided by 3, that equals $16,000. So $16,000 is what's going to be reduced from your Social Security benefits. And I'm going to explain in a few slides how exactly that reduction kicks in. I'll get there in just a moment. That is if you are earning money from January 2025 until July 2025. Again, using my example where the person is turning FRA in August of 2025. However, let's say a person collects Social Security before 2025. They collected in 2024 or 2023 or 2022. Well, if you collect it before the year you turn FRA, so that's the top row in the chart. So before the year you turn FRA, you're only allowed to earn $19,000. So the earnings limit is much stricter. You're only allowed to earn $19,560. Not only is the earnings limit stricter, but the penalty is stricter as well. For every $2 in excess, you lose $1 of benefits. So let's go back to my example. If you have somebody who's earning $100,000, they're only allowed to earn $19,560. So that means they're in excess by about $80,000, in the vicinity of $80,000. And remember, for every $2 in benefits, for every $2 in excess, you lose $1 benefits. So if you're $80,000 in excess and there's For every 2, you lose 1. So basically, you're going to lose half of 80,000. That's going to mean you're going to have a $40,000 reduction in benefits. I have news for you. If you have a $40,000 reduction in benefits, that's going to wipe out your entire Social Security. So you might not get Social Security that year at all. And the earnings test applies every year that you're below FRA. So if you collected at 62 and you're still earning money, there's a reduction. If you earn at 63 and you're still earning money, there's going to be a reduction. Once, however, you reach the month that you turn FRA, so in my example, August 2025, once you reach that month, there is no more earnings test. Now, I have a few rules about that earnings test. The first rule I want to share with you is that the earnings test does not care about the income you made before you started collecting. So what that means is, let's say you start collecting. Let's say you are age 62 in January of 2022. Let's just pretend that you're age 62 in January 2022. Okay, but you're still working in January 22. You stopped working in July 2022. And in July 2022, that's when you begin collecting Social Security benefits. However, from January 2022 until June of 2022, you were still working and you were still earning. So the question is, if you are still working from January 22 until June 2022, do those earnings get held against you when you start collecting Social Security in July of 2022? And the answer is, as you guys can see in the first bullet point on the slide, those earnings do not count. We don't care about that. The fact that you were earning money before you started collecting Social Security is irrelevant to Social Security. All Social Security cares about is if you're earning money while you're collecting Social Security. But if you were earning money before you collected Social Security, that's not a concern for Social Security. Okay? What's one thing to consider? Next bullet point on the slide. Only your income affects your benefit. Your spouse's income does not affect your benefits. So let's, for example, say you're married, you're not working, and you're collecting Social Security. Your spouse, however, is working. Do their earnings cause a reduction in your benefit? And the answer is no, it does not, because you are not working. So the fact that they are still working, their earnings do not cause a reduction in your benefit. With that being said, there is an exception to that rule. And the exception, it actually makes a lot of sense if you think about it. The exception is if you are collecting a benefit based on your working spouse, meaning you're not collecting your own, but rather you're collecting your working spouse's benefit. In that case, if you are not collecting your own benefit, but rather you're collecting your working spouse's benefit, and your spouse is still working, then their earnings do impact the benefit that you are receiving. Okay? In that case, by the way, if your spouse is still working, it could very well be their earnings will wipe away the benefit that comes from them, and you'll be left only with the benefits that you could collect on your own record. So just be aware that your spouse's earnings should not impact you if you're collecting your own record. But if you are collecting from your spouse's record, then their earnings will impact you. Okay, another thing to consider about the earnings test. If you guys see the next bullet point, the third bullet point on the slide, Social Security does not pay prorated monthly benefits. They don't do that. But instead, they will withhold full monthly benefits until the earnings test reduction amount was withheld. And then the next year, they're going to make a special makeup payment. Yes, that's English. Let's explain what that means. Okay, I'm going to give you guys an example of that on the next slide. So let's pretend somebody collects Social Security early, okay? And let's say they collected at age 62. And their monthly Social Security benefit will be $2,000 a month. So $2,000 a month, that's $24,000 a year. That's what they should receive from Social Security. However, they were still working. They were still working. And if you see in the second bullet point, they were earning money in 2022. How much were they earning? They were earning $30,000 in 2022. Now, you may remember that the earnings test allowance in 2022, if I back up 2 slides, their earnings test allowance, if you guys recall, was $19,560. So that means they allow you to earn $19,560. This person, however, is making more than $19,560. They're making $30,000. So they have an excess. Let's do the math. The excess on the fourth bullet point, they're making $30,000. They're only allowed to make $19,560. So what's the excess? $10,440. So they are in excess by $10,440. Based upon the 2-for-1 penalty, meaning for every $2 in excess, you lose $1 benefits. Based on the 2-for-1, they should have their Social Security reduced by $5,220. Now, the question is, how does Social Security reduce the benefit by $5,220? Remember, this person's monthly Social Security benefit is $2,000 a month. So how does Social Security capture that $5,220 benefit? Do they just straight out withhold $5,220? Nope. That's intuitive. However, that's not what happens. Social Security does not like sending you prorated payments. So they're not going to send you a payment that is reduced just to capture the reduction of $5,220. So what they're going to do instead is, if you guys see in the bottom, I explain it, that Social Security is going to withhold 3 months of $2,000. 3 months of $2,000. So 3 months of $2,000, that's $6,000 that they are going to withhold from you. Now, you're probably up in arms. Hey, Social Security, you should not be withholding $6,000. You're only supposed to be withholding $5,220. I know, they know. However, they don't like sending you a prorated payment. So what they're going to do is they're going to over withhold $6,000, and then at the beginning of next year, they will send you a special payment of the difference that they over withheld. So in this case, they over withheld $780. They were only supposed to withhold $5,220, but yet they withheld $6,000. So that's an excess of $780 that they over withheld. So what they're going to do is at the beginning of 2023, they're going to send you a special makeup payment of $780. Why do they do that? I don't know. Why is this any better than a prorated payment in 2022? I have no idea. But for some reason, Social Security feels good about themselves by doing this. So that's what they do. Okay? Another detail that I want to point out over here, this is a very interesting detail, is that benefits that were withheld due to the earnings test, this is the last bullet point on the slide, benefits that were withheld due to the earnings test will be converted into time not in receipt of benefits, which will reduce any early receipt penalties once you reach FRA. Once again, that is English. That really is English. Let's think about what that says. I'll ask it as a question. When Social Security reduces benefits, so in the example I just gave you, this person had $5,220 of their Social Security benefit withheld. Please tell me, that $5,220 that was withheld, is that money gone forever? So you would think, well, yeah, they withheld it, so it's gone forever. I understand why you're saying that. However, it's a little bit more nuanced than that. It's actually not gone forever. What Social Security is going to do is they're going to treat those 3 months that you were not receiving benefits, they will actually treat those 3 months as if you weren't collecting Social Security. Now, remember, if you collect Social Security early, there's a reduced benefit. And that's why some people are scared to take Social Security early, because they don't like the idea of reduced benefits. And as I mentioned earlier, even though there's a reduced benefit, in general, I tell people to take Social Security early. In this case, this person had 3 months of Social Security benefits withheld from them. So what that means is that when they reach full retirement age, Social Security will actually recalibrate their benefit to show that they should not have gotten a reduction for those 3 months. Okay, I'll give you guys an extreme example. Okay, so forget about 3 months for a second. Let me back up, give you an extreme example just so you can capture the flavor of what I'm saying. Imagine a person collects Social Security at 62. However, right when they collect Social Security, they were dinged with their earnings test, because when you file for Social Security, they're actually going to ask you, do you anticipate making any money this year? And you're going to have to declare the money that you anticipate making. And if you declare to Social Security that you're going to be making too much money, they're going to withhold benefits right out the gate. They're actually not even going to send you benefits if you declare that you're making too much money. So imagine a person files for Social Security at the age of 62. However, they were always making too much money, and therefore at the age of 62, no benefits were sent to them because all the benefits got withheld. They were making too much money. They were withheld to their earnings test. So they filed at 62, but they never claimed at 62 because they were making too much money. And then again at 63, they were making too much money, so they got nothing. And then at 64, and then at 65, and then at 66, all the way till 67. They had claimed Social Security from 62, but they received zero benefits from 62 to 67 because every one of those years they were making too much money. So the question then becomes, when they turn age 67, will they get their full 67 benefit, or will they get the reduced 62 benefit? After all, they collected at 62, didn't they? Didn't they apply for Social Security benefits at 62? So which one do they get, the full 67 or the reduced 62? And the answer in that example is they're going to get the full 67 benefit, even though they claimed at 62. Why? Because who cares that they claimed at 62? They never got a benefit at 62, nor at 63, nor at 64, nor at 65, nor at 66. They never got any benefit early. So because they got no benefit early, it's treated as if they never received Social Security early, and there's never a reduction due to their early receipt of Social Security. That's one example. Let's give another example just to flesh it out. Imagine a person claims Social Security at 62. However, they were making money, and they were making enough money to erase half their yearly Social Security benefits. Half. Not the entire year's benefit, but half the benefit. And that happened again at 63, and at 64, and at 65, and at 66. So basically, every year from 62 to 66, they were not receiving their full benefit. They were only receiving half the benefit. Come 67, when they turn 67, will they continue receiving the reduced 62 benefit? Will they receive the full 67 benefit? Or will they receive a benefit that is based upon sometime in between 62 and 67, basically 2.5 years in, so that'll be 64 and a half. Is their benefit based on the reduction of 62, the full benefit of 67, or the reduction of 64 and a half? If you guys are following me, their benefit is going to be based upon 64 and a half. Why? Because they never received the full 5 years of benefits. They only received half of the 5 years of benefits. So the other half that they didn't receive, it's as if they weren't collecting during those 2.5 years. Right? It actually makes a lot of sense. Believe it or not, I know it's a little bit surprising to hear that Social Security actually got it right. But when you think about some of the ways they structure it, it does make some sense, the way they structure it and the way they penalized it. Okay? Fine. Very, very good. Now, let me back up a little bit to this slide right over here. As you guys can see in the slide, if you're making too much money, they reduce your benefits. Okay. However, the earnings test only applies to earned income. Earned income. So the tricky thing is defining what counts as earned income. I'm going to give you guys a whole bunch of categories. And I want you guys to think to yourself, is this category of income considered earned income, or is it considered unearned income? So again, I'm going to list you guys off a whole bunch of categories. I want you to think to yourself, is this category of income considered earned income, or is it considered unearned income? Let's start with the very first category of income. Are you ready? The first category of earned income. I'm sorry, the first category of income. I'm not going to say whether it's earned or not. That's for you guys to tell me. The first category of income is wages. Let's say you're a W-2 employee, and you have wages. Is wages considered earned income? What do you guys think? Is wages considered earned income? So the answer is wages are earned income. Yes, they are. Wages are earned income for sure. Okay. Let's give another form of income. I want you guys to tell me whether this is earned or unearned. Lump sum annual leave payout. Lump sum annual leave payout. When you guys retire, you're going to get a lump sum of your annual leave paid out. Is that lump sum earned income or unearned income? Is that lump sum earned income or unearned income? So this is a tricky one. This is actually very tricky. The lump sum annual leave payout, okay, brace yourself. It is both earned income and unearned income. That's crazy, right? Let me explain what I mean, okay? It's both earned income and unearned income. For purposes of the earnings test, the annual leave is not earned income. Let me say it again. For purposes of the earnings test, the lump sum annual leave is not counted as earned income. However, it is treated as earned income in that you will owe Social Security tax on that earned income. So that Social Security tax is going to be 6.2%. So the lump sum annual leave is treated as earned income in that you will owe Social Security tax in it. However, it is not considered earned income for purposes of the earnings test. And the rationale behind that is because the annual leave may not have been earned this year. It may have been something you earned in a prior year, but it only got paid out to you in this year. So that's why it's considered earned income in that you owe Social Security tax on, but we're not going to consider it earnings for this year because you might not have earned it this year. Annual leave may have been earned in the previous year. Okay, that's great stuff. By the way, just so you guys know about that annual leave, I have a little bit of a strategy for anybody here who's thinking about retiring and they want to know how to minimize the taxation of that annual leave payout. So there are a couple of ways you can do it, but I'm just going to share with you one of them that's related to Social Security. If you get that annual leave payout before December 31st, you might be able to avoid paying Social Security tax on the annual leave. The reason is because Social Security does not tax all of your income. I'm sure you guys know this. Social Security has a cap. They only tax your income up until a certain dollar amount. That dollar amount in 2022, I have to remind myself, I think it's like 147,000, whatever it may be. That amount, 147,000. So what that means is Social Security will only tax your income up to 147. If you are earning beyond 147, anything beyond 147 avoids Social Security tax. Some of you guys know exactly what I'm talking about because come October, November, December time, your take-home pay goes up. You find extra money in your take-home pay. And you're like, ooh, extra money. Where did that come from? You know exactly where that came from. That is because you were earning beyond the 147 cap, and therefore any earnings beyond that avoid Social Security tax. So if you guys are hearing what I'm saying, if your income is beyond 147 and you receive the annual leave payout before the end of the year, and that annual leave is being paid out, is considered income, but it's income beyond the 147, you will avoid the 6.2 Social Security tax on that annual leave income. Okay, that was an aside. Let's come back over here. So the first category we spoke about was wages. That is earned income. The second category we spoke about was the lump sum annual leave. That does not count as earned income for the earnings test. Let's give a third example of income. Your federal pensions. Let's say you have a FERS pension. Is your FERS pension considered earned income? Is the FERS pension considered earned income? And the answer is nope. FERS pension, not considered earned income. Not considered earned income. Let's give another example. What about Social Security? Is Social Security itself considered earned income? Oh my goodness. That would be outrageous. If Social Security itself was considered earned income, that would be outrageous. Because you know what that means? That means that Social Security will give you your benefit. And then after they give you your benefit, they're like, oh, now you made too much money. Now we take it back. That would be outrageous. Completely outrageous. Okay, let's give another category of income. TSB distributions. Are distributions from your TSB earned income? Distributions from your TSB, is that considered earned income? And the answer is nope, not earned income. Distributions from your TSB, not earned income. Now, one second, is it taxable? Yeah, it's taxable. I mean, if it's traditional, then it's taxable. I'm not saying it's not taxable. In fact, all the categories that I've been talking about are all taxable. Your TSB traditional distributions are taxable. Your Social Security is taxable. At least most of it is taxable. Your first pension is taxable. Again, most of it is taxable. There are a portion of Social Security and a portion of your first pension which are not going to be taxable. But other than that, it's taxable. Your annual leave lump sum is taxable. All the categories I gave were taxable, but they're not necessarily earned income. Okay, let's give another example. What about distributions from your IRAs? Is that considered earned income? And the answer is IRA distributions are not considered earned income. IRA distributions are not considered earned income. Okay, what about distributions from your non-retirement investments? So let's give an example. Let's say you have dividends from your non-retirement investments. So you have stocks and the stocks issue dividends. Are dividends considered earned income? And the answer is not earned income. Not earned income. What about interest? Do you have interest payments from your bonds or from your CDs? Is that considered earned income? And the answer is not earned income. Not earned income. What about capital gains? If you have an appreciated asset and you realize the appreciated asset, is that considered earned income? And the answer is right. Capital gains, realized depreciation, is that considered earned income? Not earned income. Okay, not earned income. So you guys hearing this? All these categories, are they taxable? Yeah, they're taxable. I'm not saying they're not taxable, but are they considered earned income? They are not considered earned income. Okay, let's give another example. Rental income. For anybody here who has a investment property and it's generating rental income, is rental income considered earned income? And the answer is not earned income. Not earned income. Again, taxable? Yes, taxable, right? Something could be income and therefore taxable, but it's not necessarily earned income. Earned income, the way they define it is that you materially participated in the generation of that money. Okay? That's the way they categorize it. I think there might even be more specific definitions of it there. But if you think about it, with your rental income or your dividends or your capital gains, that is not something that you materially participated in the creation of. Now, you could argue that maybe you did, but like in general, that's not considered material participation. It's not like you invested hours and hours to generate that money. It's more just like the asset is there and the asset produces money for you. Okay, let's give another example. And this is where you might detect how to outsmart the earnings test. Okay. Let's say you're a federal employee that decides to start their own business in retirement. I don't know if that applies to anybody here. Is anybody here thinking that they may want to start their own business in retirement? Or perhaps there's somebody who already has their own business. Or maybe you are married to somebody who has their own business. If you have your own business and your business is making money, is that self-employment income? Is that considered earned income? Self-employment income, is that considered earned income? And the answer is not necessarily. Not necessarily. You have a say as to whether or not that self-employment income is going to be treated as earned income or not. Most people don't know this. Most people, when they start their own business, they started as a sole proprietorship, or they even started as an LLC, but it's a single member LLC, or even a multi-member LLC. But it is it's them materially participating in the work over there. So most people don't know this. When they start their own business, they started up as a sole proprietorship or even an LLC. And when they get hired by whoever it is that pays them, the one who's paying them it looks like they're paying the company that they started, but really they're paying you. So let's say you started, Stefan Zeltzer Enterprises, and somebody hires you and they write a check to Stefan Zeltzer Enterprises. Really what they're doing is they're just paying Stefan Zeltzer. That's really what they're doing when you have your sole proprietorship or your single member LLC. That's really what's happening. However, it did not have to be like that. You had a say in the matter. You still have a say in the matter. You could actually design your business as a corporation, specifically an S corporation, an S corporation. Now, you might be scratching your head and wondering, little old me running a corporation? It's just me, Stefan. Why would I make a whole corporation when it's just one person? And the answer is, you could have a one-person corporation, and the reason why you may want to do it is because of exactly the benefits we're about to enumerate. See, what happens is when you run your single-person corporation, you are actually functioning in a dual capacity. On the one hand, you're the big boss. On the other hand, you're the best employee you've ever had. So now what happens is as follows. The people who hire you, when they write a check to your company, they're not writing a check to you. They're actually paying the corporation. And then the corporation turns around and pays you. But which one of you is your corporation paying? You get to control that. Are you paying yourself the big boss, or are you paying yourself the best employee? The money you pay yourself as the best employee, that is wages. That is wages. And because it's wages, that will count as earnings for the earnings test. Yes, it will. Oh, and by the way, not only will it count as earnings for the earnings test, but it also counts as self-employment income, and you're going to have to pay both halves of the self-employment tax, the employer part and the employee part. That equals 15.3% taxation. So any money that you pay yourself as the best employee, be prepared, you will have at least 15.3 taxation on that money. At least. That's just the self-employment tax. Forget about the other forms of income tax. However, the money that you pay yourself as the big boss, well, that's not wages. That is a shareholder distribution or a dividend distribution. And dividends are not considered earned income. So if you think about it, let's give an example. Imagine you have your business, and your business is making $70,000 a year. 70, okay? What you could do with that $70,000 is you could pay yourself the best employee right up to the $19,000 threshold, right up to the threshold. And then anything beyond that, you could pay yourself as the big boss in the form of a dividend, a shareholder distribution. And thus, you have successfully avoided the earnings test on the entire $70,000 that your business is making. Are you guys hearing this? Right? Delicious. This is unbelievable. Anybody here who has their own business right now, this is something they should be looking into right now. And by the way, I wouldn't be surprised if those of you who are following my thinking, some of you may actually be getting very creative with your thoughts, and you might have a question lingering. You might say, Stefan, I like your idea so much, let's take it to the next level. In my example of $70,000, why would I pay myself, the best employee, $19,500? Why would I do that? Why don't I just pay the entire $70,000 to the big boss as a shareholder distribution? What's the benefit of doing that? Well, number one, you avoid the earnings test, which we said before you would. But the second benefit is because any money that I pay myself as wages, I have to pay 15.3% self-employment tax. So why am I paying myself $19,000, which I'm going to owe 15.3% self-employment tax? Why don't I just pay the entire $70,000 to the big boss and avoid 15.3% taxation on the entire $70,000? That's a very creative idea. I like your creative thinking. The problem with that is it's a major red flag. Major red flag. Because if you think about what you're saying is that you have a business and the business is making $70,000 a year. And who's doing the work? Nobody. Nobody's doing the work. Just somehow the 70,000 gets made. Nobody's doing any work. So that, in the eyes of the IRS, that's a major red flag. So if you're going to be designing a business where you're paying yourself, the big boss, and also as an employee, you need to make sure that you pay yourself, the employee, a justifiable amount. This is the type of thing which an accountant will help you with. By the way, this type of stuff, as qualifying income as either wages or shareholder dividend, this is the type of stuff that accountants do all day, every day. They look at the dollar bills and they say, how should we classify this money? Should we call it income? Should we call it wages? Should we call it shareholder distribution? They do that with the income. They do it with the expenses as well. Okay? Beautiful. Beautiful, beautiful. So this is one way that you could successfully avoid the earnings test. And if anybody here has any hesitation about how to structure this S-Corp structure, I would encourage you to speak with an accountant. This is the type of stuff that they do all day, every day. Okay, beautiful, beautiful. That's what I wanted to share with you guys today. And let me open the floor to some questions. Okay, just so you guys know, if you want to file for Social Security, you can file for Social Security online. They have an automated system of processing your Social Security requests. Thank goodness they are automated, as opposed to some other federal agencies we know that are working out of a cave in Boyers, Pennsylvania. Ahem. I don't know if you guys know what I'm referring to, but you can check it up. Which federal agency is working out of a cave in Boyers, Pennsylvania? Go ahead, go have some fun and look it up. Okay, so with that being said, I want to open the floor to questions. But before I open the floor to questions, I do want to mention to you guys, as I said earlier, this class does not happen with a vacuum. This class happens because I have people who are supporting me and encouraging me. Those are my clients and my members. If anybody here is interested in becoming a client or a member, I am going to publish a button in the sidebar. If you guys see right now, I just opened up a button in the sidebar. It is a button where you could click learn more and request a meeting with me. So anybody here who is interested in a complimentary session with me, the way you request that complimentary session is by clicking on that button in the right side of your screen where it says learn more and you can meet with me. That button is going to take you to a web page. The web page is going to have a form. You can fill out the form and request your meeting. Okay. I encourage you guys to do that right now. Anybody here who is interested in talking with me, whether it's about Social Security or about federal benefits or about retirement planning or whatever it may be, I'm happy to discuss it with you. The way to request the complimentary meeting is by clicking that button now and requesting that the meeting via the form that the button takes you to. Okay, beautiful, beautiful. Now let me turn over my attention to the questions. Let's see if I have any questions. Okay, let's see if I have any questions. I see Vince has a question. What if you're already retired federal employee under 65 and you want to keep FEHB and want to avoid auto Medicare enrollment? Ooh, Vince, very, very good observation. Okay, so if a person is already a retired federal employee under 65 and you want to keep FEHB and want to avoid auto Medicare enrollment. So Vince, if you are collecting Social Security before the age of 65, when you turn 65, you will automatically be enrolled in Medicare. You are correct about that. However, Vince, you can opt out of Medicare B, which costs you money. Medicare A is free. And by the way, even though it's free, it's not exactly free because by having Medicare A, you're no longer able to contribute into an HSA account. So you lose a little bit of a benefit of HSA account once you have Medicare Part A. But if you're collecting Social Security early at 62, once you turn 65, you will have to have Medicare Part A. There's nothing you could do about it. And by the way, Vince, if somebody was saying to me, I've had this question before. Someone asked me, Stefan, should I avoid taking Social Security early? This way, I could avoid Medicare Part A when I turn 65 and still contribute to an HSA when I turn 65. So the answer to that is no. I would not tell you to delay Social Security just so you could continue your HSA participation, because the HSA participation is only saving you, let's say, a couple $1,000s a year with the HSA contributions. So let's say you could contribute $8,300 and you're going to be saving around $2,000 in taxes or $3,000 in taxes. So you're right, you're saving $3,000 in taxes, but you just gave away collecting about $20,000, $25,000, $30,000 in Social Security benefits per year over those 3, 4, 5 years. So I would not tell you to give away your $25,000 a year times 5 years, which is $125,000. I would not tell you to give away $125,000 just so you could save $3,000 in taxes. Okay, I would not tell you to do that. Okay. Okay, fine. Very, very good. Let's see some other questions. I'm scrolling down. So Tony's asking, are corporate taxes higher? So Tony, the beauty of an S Corp is that it's a pass-through entity. It's a pass-through entity. So you're not going to have taxation at the corporate level. Okay. So I hope I'm addressing your question. Okay. So corporate taxes, if you have an S Corp is a pass-through entity. So you're not going to have taxation at the corporate level. It's passed through to either the employees or it's passed through to the shareholders. Kermit is asking, only works with a corporation and not an LLC. So Kermit, it's specifically an S Corp. However, Kermit, speak to your accountant and they'll let you know you could have an LLC that files taxes as an S Corp. I know, right? I was a little bit surprised when I discovered that as well. But speak to your accountant about that. You could have an LLC that files taxes as an S Corp. Yes, Michael, delicious. Okay. Let's see. Okay, passive income. Good. I see someone asking me, is OPM disability considered earned income? So OPM disability is not considered an earned income. Also, veterans benefits. If anybody here receives veterans disability, that's not considered earned income. Also, if you have a military pension, that's not considered earned income. Very, very good. Fine. Very, very good. Let's see what else. Any other questions over here? So I see that Nina has a question. Is the coordination of benefits with FEHB impacted when we are active employees versus retired employee when it comes to Medicare? Yes, the coordination of benefits definitely changes when you're working versus retired. While you're working, FEHB is primary, Medicare is secondary. When you retire, Medicare is primary, FEHB becomes secondary. However, Nina, that's assuming you have two insurances, FEHB and Medicare. If you just have FEHB, then there's not going to be a coordination because you just have one insurance. Jeff is saying, if not retired and enroll in Medicare at stage 65, would my FEHB become secondary medical? If you're still working, Jeff, your FEHB is primary. Beautiful. Okay. Once again, everybody, as I mentioned, these classes do not happen in a vacuum, and I very much appreciate my clients and my members. Some of them are on this call right now. If you guys know a client and member, go ahead, give them a hug from me. And if you guys also want to become clients and members yourselves, to learn more, click on that button, learn more, request your complimentary consult with me, and I'll tell you what's needed to get yourself started. Okay? I would love to hear from you guys. So click that button, schedule your session, and I look forward to meeting with you one-on-one. I wish you guys all the best. Enjoy the beautiful afternoon. Have a great day, everybody. Thank you for attending. All the best, everybody. All the best. Logging off.